What's going on, everybody? Somebody in my comment section a couple days ago asked me to do a review on QLDY from Defiance. They own it and they just kind of want to know what I think about it. So we're going to go through the fun, we're going to go through the pros and cons. We're going to look at charts, we're going to look at comparisons, and then we're going to talk about if it's a yield trap. And that's definitely something people need to know if it is a yield trap. So let's get into QLDY. I really thought it would get way more traction with the high income crowd, and I just don't see it being talked about a lot. Is that good? Is that bad? Well, let's find out. So it's from Defiance. It stands out as the first ETF to distribute income twice weekly. And just because of that, I thought people were really going to flood into it. And like I said, I just haven't seen that. Now, it's only been out 3 months, but we are already seeing NAV erosion even after 3 months. The dreaded NAV erosion. So when we look at the charts and comparisons to other funds, you're going to see that. It does daily sales, 0 DTEs, put spreads on Index 100, and that's how it generates its revenue for people that are getting paid twice a week. Here are some pros. It gets paid twice weekly. That's who doesn't want to be paid twice weekly, right? Obviously, there's some risk associated with this, but high yield potential because it pays, according to their website, 40%. So that's pretty high. And even for a NASDAQ fund, 40% is just really high. And it offers some indirect growth exposure to the Qs, but I mean, you'll see in the chart, it definitely gets capped like anything else in this type of category. Here's some cons. NAV decay risk, and it's already happening, which you'll see in the charts here. And, of course, you get all the downside with very little upside because they get capped. And they're very high fees. So with all this together, it's really unsustainable long term. And if we're already seeing some issues after 3 months, you can just imagine what a year is going to look like. So let's kind of get into it here. Lightning Spread, Income ETF, QLDY. Gotta like the fancy name from Defiance. So it's only been out 3 months, and we're down 2.70 in share price, and the expense ratio that you can see down there at 1.04. It's pretty expensive. It's up there for sure, just like most of these types of funds are. So let's look at the chart here. Title from Defiance, right? Here's their chart since they've been out, and let's compare it to the NASDAQ chart, or the Qs rather. Right? You can already see its lack of growth after 3 months already being compared. You can see the positive trend on the Qs for the last 3 months. Had the dip down there to the 100 EMA that the Qs did, and got a beautiful touch and hold and has ripped up since that point. And you can see here, it did bounce, obviously, from that $45 level. And now we're trading at, not we, but it is trading at roughly $49. It's got a pretty wide spread on it, too. Look at the spread right now, $49.07 and then $49.12. So it's not like the Qs right here where it's a tick-for-tick spread. So a little high spread there. But it to its credit, it did bounce a little bit up here from that 45 and a $4 bounce up there to 49. And you could see there on the chart in comparison. So after 3 months, we already are kind of drifting away from the Qs. So not good there. Here are its holdings. You can see here, NDX right there, and the put spreads that they offer. Okay, here's their distributions after 3 months. Now, it's only 3 months, granted, but we're already seeing lower highs and lower lows. So the distributions are already going down over time. Meanwhile, the Qs are steadily rising up over the 3 month period that we're looking at. So that's already a major warning sign. If the distributions are already declining, meaning lower highs and lower lows, while the Qs are trending up over the past 3 months, that's not a good sign. What do you think is going to happen when the Qs correct or crash? Not good. So let's get into comparisons. We're going to compare QLDY to QDTE, which is probably its closest competitor. We're also going to throw in QQQI and GPIQ. So total returns from the time that this has come out, you could see here QLDY lags behind QQQI, GPIQ, and QDTE. Only a couple points off of QQQI, but again, it's only been 3 months. So if you can imagine this stretched out over a year or two, how wide that gap will eventually be. Price change, it's negative. Meanwhile, everything that it competes with is positive. Obviously, not a good sign there. I mean, you got to think about it. You're being paid twice a week. So every time that distribution comes in, it's going to drop by that distribution, and then it has to try to recover. So even in an upward trending market like we have been the last 3 months, it still can't get above that hump. Now, if we compare it outright, QLDY to QDTE, let's go ahead and look at some numbers here. So total return, QLDY is at 5%, meaning QDTE is at 6% with everything reinvested, and about the same if you decided to keep all the distribution. So it's got a positive total return for now. How long do you expect that to last? I don't think very long, guys, to be honest with you. Now, is it a yield trap? Let's kind of get into this. A yield trap occurs when investment's high payout lures the investors in. And that's what it's kind of doing here. Not only being paid twice a week, also with the 40% distributions. I mean, they're unsustainable. And we know it's going to erode over time. If it's already eroding after 3 months, you can only imagine what the long-term ramifications are going to be. So yes, it's showing an early signs of being a yield trap. Unsustainable yield composition. It's just, it can't pay out the kind of yield that it's paying out long-term without it eroding over time. And over time, the just the payouts are going to decrease. The total returns are going to decrease over time. It's just I don't think it's sustainable long term. I mean, it's definitely not sustainable long term. I mean, if you could catch it in some major bull run and then get out of it and get paid twice a week, okay. But wouldn't you rather just be in something better, even though you're getting paid twice a week? Wouldn't you rather just be in QQY, GPIQ, or QDTE, I guess? But yeah, I honestly don't see a reason for it with lower dividends over time already after 3 months, and it's already lagging and just getting away from the Qs after only 3 months, just separating itself from that. I definitely am not going to get in this. I don't anticipate ever getting in it. And is it a yield trap? I'd say definitely, most likely. And I think the returns are definitely just going to get worse as time goes on. Hope you enjoyed the video. Talk to you later. Bye.